If you're a high-income W-2 employee trying to reduce your taxes, here's the truth. Your options are limited, very limited. There are only a handful of legal ways to reduce taxable income. In this video, I'm going to walk you through the only levers that reduce taxable income this year. And for context, I'll be talking about income levels at $300,000 to $500,000 per year. If your income is above or below that, these could also work for you. Let's start off with the obvious one, your 401k pre-tax deduction. If you're earning, let's say $400,000 a year, and you're not maxing out your pre-tax 401k, you are voluntarily paying more tax than required. The 401k contribution limit for an employee is $24,500 in 2026. At a 35% to 40% marginal tax rate, that one decision reduces this year's tax bill by roughly $8,500 to $10,000. If the objective is lowering taxable income this year, this is the first switch you flip. Make sure you're maxing it out and make sure it's set to pre-tax if that's your goal. Next, if you're eligible for an HSA or a high deductible health plan, you have another lever. For families, the annual limit is roughly $8,750, and at high marginal rates, that's about $3,000 to $3,500 less in taxes this year. Direct reduction, clean, mechanical. Confirm eligibility. Max it out if you can. Make sure it's going through payroll pre-tax. Another option is an FSA. An FSA works similar, pre-tax dollars for medical expenses. Lower income, lower tax. Contribute $3,000 to your FSA at a 37% bracket, and you're saving roughly $1,100. But here's the rule. This is a use it or lose it account. If you don't spend it, you forfeit it. This is not long-term money. It's a tactical annual tool. Estimate carefully and don't overfund it just to chase a deduction. Another tool available to you is tax loss harvesting. This one only applies to taxable brokerage accounts. If you sell an investment at a loss, that loss offsets gains dollar for dollar. If losses exceed gains, up to $3,000 offsets ordinary income. At a 37% bracket, that's roughly $1,100 saved this year. Another lever is charitable contributions. Now, charitable contributions reduce taxable income only if you itemize. If you don't exceed the standard deduction, the math doesn't change. If you do itemize, a $20,000 donation at a 37% bracket reduces taxes by roughly $7,400. And if you hold appreciated stock, donating shares instead of cash makes the gift more efficient. Same deduction, but no realized capital gains. Another lever that isn't available to everyone is a non-qualified deferred compensation plan. If your employer offers deferred compensation, you can push income into a future year. Let's say you defer $50,000 of bonus at a 37% bracket. You reduce this year's federal tax rate by roughly $18,500. You're not eliminating tax, you're shifting when it's paid. But for reducing taxable income this year, it works. Another way is through tax credits. Credits reduce taxes dollar for dollar. There's credits like the child tax credit, dependent care, education credit, EV credits, energy efficient home improvements. Each has eligibility rules. Each has income phase outs. But if you qualify, they reduce your tax bill directly, not just your taxable income. Review major life events before filing to see if you qualify. And that's it. Those are the switches. Now, if taxes seem to be a problem and you want to stop being surprised every April, if you want to coordinate bonuses, equity compensation, withholdings, and elections before year's end, then reducing taxable income is only part of the picture. In my next video, Tax Planning Tips for High Earners in 2026, I'll show you how to actually build a tax plan, one that helps you avoid surprise bills and creates control over your taxes now and years ahead. Click right here if you want to build a tax strategy.